Everyone talks about mortgage rates and affordability. But did you know that the type of mortgage that you choose can be just as important? In this video, we're going to help answer the question how to choose the best mortgage and the type of mortgage that's right for you. Now, let's get started. So, how do you choose the best mortgage? The best mortgage is really an individual decision. There is no one fit for all. A good place to start when trying to select your best mortgage option is to think about what your personal situation entails. Where do you want to live? What are your non-negotiables in your next home? How long are you planning on staying in that home? And how much debt do you currently have? What do you feel comfortable with in terms of monthly payments? What's your financial situation? And most importantly, what are you trying to accomplish? Answering these questions will give you a strong foundation for selecting both the best home to buy and the best mortgage for your situation. Here in the Caledon and surrounding area, we're seeing a lot of our buyers wanting to get into their next home. Their circumstances have changed. In some cases, their family has grown. In other cases, their families have gotten smaller. And as empty nesters, they're looking to downsize. Whatever the situation is, the goal is to move on and into a home that will serve your current needs so that you can live a comfortable life. At first, many home buyers are a little hesitant, and like you, they wonder if now is a good time to buy. Should they wait until rates decrease further? You may have had some of these same concerns. Many enlightened home buyers are choosing to take advantage of the perks that the current market offers, such as choice in inventory, the ability to negotiate, and the luxury of having to go back and even have a second look at the home to ensure that it's the right home for you. Savvy home buyers are finding their next home, the one that serves them. And in terms of mortgages, many are opting for a fixed 3-year term, and here's why. Economists are expecting rates to decrease over the next while and into 2024 through 2025 and into 2026. Savvy buyers are looking to purchase a home now as the current inventory is showing that they have choice in the market and they can negotiate on price and terms. As interest rates continue to decrease, buyers will continue to re-enter back into the marketplace, swinging that pendulum from one in which there is inventory and negotiability to one where there is not enough inventory available for the number of buyers in the market, because we know that we still have a fundamental shortage of homes here in the Greater Toronto area. As this pendulum swings, the law of supply and demand will come into focus and home prices will rise and negotiability for buyers will unfortunately fall. It is impossible to time the market. However, savvy buyers are taking advantage of the situation. They are entering the market, having the luxury of choice, time to perhaps see a property more than one time, and the ability to negotiate. Many are selecting a 3-year mortgage term. Why, you may ask? They are hoping to renegotiate their interest rate as an early renewal in about 2.5 years when rates will likely have had time to decrease. So in essence, they are marrying the house, they are finding their perfect home, and they are dating the rate, meaning selecting a rate that will only be with them for a short period of time. So if you've been thinking about buying and waiting for rates to go down, this option may be one you want to consider. Now, this isn't the right mortgage type for every buyer. A mortgage professional can assess your financial situation in connection with your present and future plans. Real estate should be looked at as a long-term investment, at minimum 3 to 5 years. In selecting the right mortgage for you, there are several factors that you should take into account other than just the rate or term of the mortgage. Wondering what you should consider when selecting a mortgage? Today, we're going to talk about 4 factors that you should consider when choosing your mortgage. I'm Evelyn Lopes with the Evelyn Lopes Realty Team and iPro Realty here in the Caledon, Orangeville, and surrounding area. And if you'd like to see more videos like this one, be sure to hit the subscribe button for Caledon area real estate news and advice. Now let's get back to our conversation. Let's take a closer look at what things you should look at when selecting a mortgage. Number 1, your credit score. Your credit score is a 3-digit number that impacts the mortgage you can get and the interest rate you'll pay. A score score of 720 or higher gets the best rates, but you still have options if your score is lower. To get a mortgage with less than 20% down, you'll usually need a score of at least 600. 680 is better. Unless you're new to Canada, new immigrants might qualify for a special newcomer mortgage, even with little credit history. If your score is low due to missed payments or high debt, you might need to look at alternative lenders like B lenders who have more flexible standards. Other options may include some home sellers who may offer owner-financed mortgages, and alternatively, private investors who specialize in subprime loans known as C lenders may choose to work with you. If your score is below 600, options are more limited, but paying down debt to improve your score could help you get a better mortgage, and the interest that you save with a more competitively priced loan could enable you to buy a more desirable home. Number 2, your income and expenses. Your income and expenses affects the mortgage that you can get. Lenders want to see that you have enough money left after paying your monthly bills. They look at your income and debts like student loans and credit cards to decide if you can afford a mortgage. They use something called the total debt service ratio, known as the TDS ratio, which compares your income to all of your debts. The Financial Consumer Agency of Canada suggests a TDS ratio of 44% or less, but some lenders may accept a higher ratio. Lenders also consider home-related costs like property taxes and heating. Your total housing cost shouldn't take up more than 39% of your income, which is known as the gross debt service ratio, or GDS. Lower TDS and GDS ratios improve your chances of getting a good mortgage, especially with stricter rules from Canada's top bank regulator. Unregulated lenders might be more flexible, but could still require you to pass a stress test. Number 3, your expected down payment. Your down payment size affects the mortgage that you can get. You don't need a 20% down payment for a good mortgage, but you do need a decent amount. The minimum down payment is usually 5%, depending on the purchase price, your income, and your credit score. A lender might ask for more down payment. If your down payment is less than 20%, you'll need a mortgage insurance, which adds an extra cost. This cost is usually added to your mortgage payment, so you don't need to come up with this money up front. With an insured mortgage, your loan term is usually capped at 25 years, meaning higher monthly payments but less interest overall. An uninsured mortgage might allow a longer term, up to 30 years, making payments more manageable, but you'll need more equity. First-time buyers have more options like a 30-year term for new homes. Smaller down payments cost more over time and can be harder to qualify for, especially if there's a gap between your income and home price. The larger down payment, around 25 to 35%, could help you qualify for better mortgages. With the cost of housing being substantial, this is often a tough number to reach. There are some programs available to assist home buyers. There's also creative ways to finance a deal, such as having a family member gift you some money, or getting a co-signer, or having a home where you can rent out part of it. It's best to speak to an experienced lender who can go over all of your options. If you're looking for an experienced mortgage lender, reach out. We'd be happy to share our professional lender partners with you. And number 4, your lifestyle and risk tolerance. When choosing a mortgage, think about your lifestyle and how much risk you're comfortable with. If you like predictability, a fixed rate mortgage might be better for you, especially if you're worried about your budget stretching too thin. If you're okay with some risk and want flexibility, a variable rate or shorter term mortgage could give you room to adjust if rates drop. Consider your payment schedule too. If you want to pay off your mortgage early, an open mortgage might be best, but a closed mortgage usually also has a lower rate, and most offer a prepayment privilege and may also offer some additional payment options. A 5-year fixed mortgage is common in Canada and great for those who prefer stability, but it also means you're locked in for a longer time, which could be risky if rates go down or if you're thinking about selling and getting out of the market. The bottom line, regardless of the loan you choose, it pays to shop around and carefully compare terms to avoid the risk of leaving money on the table. If you have questions, reach out for a referral to a mortgage professional in our network. We have a vetted list of mortgage professionals who can explain your options, answer your questions, and work out some numbers for various situations and help you find the best mortgage loan to meet your needs. We can also develop a custom plan for securing a great home that fits your needs and your budget. We'd love to help you save money and make home ownership more affordable.